What does the dating app Bumble have in common with Deliveroo? Well, besides the fact that they're both convenient but often expensive ways to get something hot through your front door, both were subject to blockbuster IPOs this year that quickly fell flat on their faces. Deliveroo slumped 30% on its first day of trading, and while Bumble had a better first day, investors have been swiping left ever since.
No.
In a period that's been described as IPO mania, I sit here wondering, what is the crack with IPOs? Are they the piping hot, tasty investments we've all been promised? Or are they in fact just catfishing us? Let's go.
It's been a red hot year for IPOs. Investors have been flooding into these stocks.
These unicorns are rushing to market to IPO this week.
The IPO mania, it's already over.
IPO. Basically the first or initial time the public is offered the ability to own a slice of a company. First ever IPO was in March 1602, when the Dutch East India Company offered shares of its business to the public in an attempt to raise capital.
It could have been worth $7.9 trillion US.
It took almost 100 years for the Americans to catch up, with the Bank of North America being the first all-American IPO. But fast forward to today, and the Americans are knocking out IPOs at a rate of almost one a day.
Debuts of unicorns like Uber, Pinterest, and Slack, among others, drove a record $138 billion in exit value for VC-backed companies.
We've not seen this much IPO activity since the dot-com bubble, which bodes really well, doesn't it? Bumble, Airbnb, Coinbase, Trustpilot and Deliveroo are just a few companies that have come to market in the last 18 months. And let's face it, as an investor, if we see that a company that we're using almost every day is coming to the stock market, it's really hard not to get excited. But as the saying goes, not all that glitters is Tinder gold. A study by Nasdaq into the long-term performance of IPO companies showed that the day after an IPO, 50% of the businesses were underperforming the market. Literally a flip of a Coinbase. But stretch that timeline out to 3 years and around 64% of the businesses were underperforming. You gotta love the finance world, haven't you? Data clearly shows that IPOs are highly risky for individual investors, but in the last 18 months, the finance world's been like
unleash hell.
Benjamin Graham, the guy who mentored Warren Buffett, once said jokingly that IPO actually stands for "it's probably overpriced,"
$50.
or imaginary profits only, or the insider private opportunity.
Would you let in Homer Glumplet?
In order to understand if getting involved in these businesses on the day they launch is a good idea, we need to understand both perspectives of the argument. We need to look at the smart money, the people on the inside who are bringing these companies to market, and then we need to look at it from our angle as normal human being investors. Let's start with the smart money. On this side of the fence, you have the companies wishing to go public, underwriters and investment banks who facilitate the process, and then you have private investors, people who get to invest before the general public. Once you understand the motives of these parties and why they want the IPO, it can become apparent as to why it can be a terrible idea for you to get involved. First of all, the company itself. Imagine you've sweated away for years building a business. The average age of a business before it IPOs is actually 10 years. So the founders and early investors of this business have put time and effort and their own money into it to fund the business to the point where it could potentially list on the stock market.
Anybody want some pizza?
That sale or that IPO represents a once-in-a-lifetime opportunity for that business to raise cash. Once a company is listed on the stock market, if they issue new shares to raise more money, it will normally lead to the share price dropping, as you're watering down the existing shares by throwing more shares into the pile. So the IPO is the once-in-a-lifetime opportunity to cash in. Now that could be for the purpose of investing into the business or simply for the purpose of making the owners rich. Or for the more skeptical of you out there, it could be a great way of passing on a dud of a business to the general public, cashing out all the people that got in early enough. Whatever the reason it is for IPOing, one truth stands. The business owners and the early investors want as much money as possible out of that business. They're not going to sell it you for a discount. They want as much cash as they can possibly get. So while you, the investor, are hoping for a bargain that shoots up in value, it could be said that the owners of the business want the exact opposite. If on the day of the IPO, the share price quadruples, then the business owners know that they could have sold that for a higher price. If anything, you could argue that the ideal situation for the business owners is that the share price drops after it IPOs, because they know that they got the most juice out of the squeeze. In order to facilitate that transaction, then the company needs to appoint what's called an underwriter, or a financial institution that can guide them through the transaction. Now, in the example of Lyft, who are a competitor to Uber over in America, they appointed JP Morgan and Credit Suisse, or Swiss, however you want to say it.
Credit Suisse.
But there was actually 26 financial institutions involved in that transaction. Let's not beat around the bush here, call them an underwriter, but these are financial institutions in the business of collecting fees, and fees they collect. PwC claims that for an IPO worth $1 billion, the fee can be in the region of 3.5%. There is a saying that goes, one should raise money when it's available rather than when it is needed. This is why we see more businesses come to market in times when there's a bubble or the market is heated. Like I said before, we've not seen this many IPOs since the dot-com bubble. Why? Because the salesmen, because the investment bankers know right now it's easy to sell businesses.
And yeah, I got a bonus check for it. Sue me.
So we have the company who wants as much money as possible, we have the institutions who want as many fees as possible, and then we have the final piece of the smart money jigsaw, and that's the institutional investors, who get to invest before we do. I didn't have a haircut, what are you on about? So the thing you need to understand about banks and financial institutions in the context of an IPO is
Credit Suisse.
They have two clients. They have the companies coming to market, paying them fees as underwriters, which basically just means they guarantee to buy a portion of the shares to then sell on. This is why loads of financial institutions get involved in the IPO process, so no one bank shoulders all the risk of guaranteeing to buy all of the shares. That's why the bigger the IPO, you get 26 different financial institutions in the process. But the other client is who they're going to sell the guaranteed shares to. We buy them on the open market, but these banks have their best clients. They get to buy into the business before we do, and they want a good price. Who are you going to look after most? The business who has just showed up and you might never deal with again, or the institutional investors who you deal with on the daily? I already said for the business this is a once in a lifetime opportunity. This is likely the first and only time that that business is ever going to IPO. So there's an argument to suggest that the banks might actually look after their regular clients, the institutional investors, and look to secure the best possible price for them. Regardless, once the business and bank agree at a price that the business will sell at, this is called the issue price, and this is theoretically the price that you can buy the business at. Now, can I ask you a question? Have you ever thought about investing in a business on day one? You see the price in the press and you think, yeah, I'll pay that, $40, whatever. You come to buy it, you're first in line, and the price is already higher than that. The problem is, the banks sell all the shares at issue price to their best customers. When a company IPOs, only a small fraction of the shares are made available to us, the general public. And if there's a lot of demand for those shares, that can cause the price to rise. Stockopedia found that 89% of businesses went on sale above their listing price on the day of an IPO. Basically, you didn't even have a chance at getting it at recommended retail price.
How much is your fabric?
Richard Wilson, Chief Executive of Interactive Investor, said there's not much fairness when it comes to IPOs. It's rare that the general public are offered the opportunity to get involved. The city institutions have tended to receive preferential treatment, leaving the rest of us to pay significantly more for the stock once the company floats. It effectively amounts to daylight robbery. So why do investors time and time again get excited and pile in on the day that a company launches? And trust me, it's not new behaviour. In 1825, we saw the first example of IPO mania. A man was crushed to death in a stampede of investors trying to buy shares, and it was reported that the wealthiest investors hired goons to punch their way to the front of the line.
Kablooey into the kisser!
By 1829, the stock had lost 25% of its value. In this book, Your Complete Guide to Factor-Based Investing, the authors present an argument as to why they think people go so crazy over IPOs. They discuss Barbaras and Huang's 2008 study, Stocks as Lotteries, that concludes investors like investing in things that have the potential for huge payouts. Shout out to all my crypto kings and queens. 70% of adults in the UK play the lottery on a regular basis, even though it's widely known that the odds of winning are around 1 in 45 million. Same thing kind of applies with IPOs. People like the idea that it could shoot to the moon and make them rich, so loads of people pile in. But because loads of people pile in, it becomes overpriced and then the returns are worse. A Stockopedia study found the average share price compound annual growth rate was minus 4.3% for 258 UK IPOs studied over 5 years. I'm not saying you shouldn't invest on day one of the IPO, that's up to you. If you're happy with your due diligence and wish to hold the company long term, then short-term volatility should not concern you all that much. But IPOs are designed for shifting shares, from the company who wants the most money or the bank who wants the most fees and to look after their best clients. Just be careful. All I'm saying is, as sensible investors, we should look to avoid hype, because hype makes share prices move away from fair value, and there's nothing more hypey than a IPO.